Hello and welcome to Money Control. We continue with our conversation series on how to navigate 2025 with 5 big ideas, themes, trends and stocks to pursue in 2025. Today I have with me Saurabh Mukherjea, founder and CIO of Marcellus Investment Managers. So thank you so much, Saurabh, for joining me this morning. As I said, 5 ideas to navigate 2025. Bring it on.
I think 5 is a big ask. Let me tell you what we've been trying to do over the last couple of years, especially over the last year, Mahalakshmi, when we realized that we're heading into a cyclical downturn. We broadly decided we'll focus on 3 areas. We'll focus on pockets of comfort in the financial services ecosystem. Second area is we'll focus on export-centric plays. We believed a year ago, and we still believe that exports are going to have a good run, courtesy the rupee devaluation and the economic strength of the United States of America. And the third theme was, once we saw the general election results, we realized that over the next 2, 3, 4 years, our political class will bend over backwards to trigger a rural revival. So we focused on rural-centric plays. So those are broadly the 3 themes, right? Focus on pockets of comfort in financial services. So just to begin with that, right? I think that if you step back and think about it, 21, 22, 23, 24, low-quality financials had a great run. And, I know better than most because we didn't invest in low-quality financials and we missed out on several multi-baggers, right? Plus, I guess as everybody who's watching knows, many Indian families have reduced their savings account corpus and invested in SIPs, stock market. And whilst a lot of people believe that money stays within the system, within the banking system, clearly savings account and FD corpuses are reducing and the current account piece is going up. But the two are not like for like, and overall therefore banks' ability to extend credit has diminished, which in turn is resulting in NPAs going up, right? So in this sort of environment, I think lenders who are strong on liquidity, strong on deposit flow, strong on asset quality, I think will excel. And my long-standing favorite, a big part of our portfolios is HDFC Bank. So it's a big part of our portfolios. We've been investors for many years. We haven't made money for the last 3.5 years, but I believe this sort of environment, the next year, perhaps even a couple of years, tight liquidity, economic downturn, NPAs going up for other lenders, I think is ideal for HDFC Bank. So that I would put that pretty high up on the list of ideas. If somebody who's watching doesn't have HDFC Bank, I would invite you to think about it. The disclaimer being it's a big part of our portfolios in Marcellus. My parents and I are clients and therefore we are beneficiaries of that. And similarly, staying within the financial system plays, Mahalakshmi, I would say general insurers will have a decent run. There's an accounting change coming where we move from IGAAP to IFRS, and that will help the general insurers post much better numbers. But that apart, the motor insurance cycle seems to be in the right place. Rates are hardening, and within the general insurers, whilst we have ICICI Lombard in our large cap portfolios, over the last year or so, we built a position in an insurer called Godrej. So Godrej is a Bangalore headquartered insurer. Much of the erstwhile Bajaj Allianz team has senior roles here. The reason I particularly like Godrej is, my reading is over the next 3, 4, 5 years, commercial lines in India, insuring corporates basically, will become a much bigger business. At the moment, commercial lines rates are a little soft, but I think over 4, 5 years will become a much bigger business. And the key here is, can you reinsure? If you say insure Money Control or CNBC, the Network 18 Empire, can you reinsure that risk out? ICICI Lombard can. I think Tata AIA can. And perhaps beyond that, I think Godrej, because of it's owned by Prem Vatsa's group and has strong relationships with Allianz, they can reinsure the risk out. So they've built a fast-growing general insurance business, and that's probably one of our more exciting plays in financials. What we are avoiding altogether is all PSU lenders, exciting plays in NBFC space and so on. We're staying with HDFC Bank and Godrej. So that's the sort of first big theme: pockets of comfort in financial services. Then
I'll ask you a couple of questions here. So one on HDFC Bank. I know it's been your favorite for a long time, and you rightly pointed out last 3-4 years has not been particularly great. And one of the reasons is also technical, that after the merger there was a huge overhang of stock, and FIs have been relentlessly bringing down that exposure, right? Because obviously in their books also HDFC is a large play. So technically, how do you see this playing out? Because if you have prolonged selling in a stock, that itself sort of keeps a cap on the stock. Second thing is, what is it that today differentiates HDFC Bank that it should get a higher multiple? Because today it's 3.5 times book. People usually talk about, historic multiples, and we've seen HDFC Bank also quote at like sometimes 5.5, 6 times multiple. Today that entire context of banking has changed. So, how do you see the valuation bit for HDFC Bank?
Sure. So let's start with the first point, the technical point. I think for a variety of reasons, including the merger, ironically, this has become the largest weight in the index. I think this is the largest weight in MSCI India, if I'm not mistaken. And you're right, if FIIs keep selling India, then obviously HDFC Bank by default gets sold down. But I think we're closer towards the end of FII selling than towards the beginning. If you put it in a valuation context, the market is off 12% odd. I think another 10-15% we should be done with the broader market sell-off. I think it's reasonably obvious now that in a cyclical downturn with corporate earnings growing at single digits, the Nifty forward PE of 21 times, I think is untenable, unsustainable. But provided the valuation correction in India happens over the next 3 to 6 months, I think we will see FII interest returning to India. And HDFC Bank should be an obvious beneficiary of that. If you're the largest index weight, it's very difficult for your share price to go up if FIIs are
in the face of selling.
In the face of selling. But I think that selling should become buying as the cyclical downturn gets priced into the stock market. Then on the point about differentiation, right? You're right. I mean, when the economy is in go-go mode, right, then why buy HDFC Bank? You buy it's a third-class lender whose NPAs halve from some inordinate level, and it will
take another 3 years for the new NPAs to show up.
But now the ulta applies, right? Now if you see both on asset quality and on liquidity, it's very interesting how quickly the tide turns. In an earnings season where other banks are reporting 2%, 2.5%, I'm not even going to talk about the NBFCs because that's a different world. Other reputed banks are reporting NPAs with a handle of 2+. HDFC, I think the net NPA figure, I think if I'm not mistaken, is around 0.5 and the gross NPA figure is 1.2, right? So by an order of magnitude, HDFC Bank's asset quality, is superior to even other private sector banks, right? Now let's look at the deposit growth piece, right? Overall deposits in the system are growing at 8-9%, and HDFC Bank has reported deposit growth of 16%. Right? I think if you ask me, that's the key to the puzzle here. If HDFC Bank can keep running deposit growth at mid-teens, then that should allow them to then trigger a revival in their loan book. The loan book is still growing at muted rates because they were trying to bring down their credit deposit ratio.
Right.
But it seems relatively clear, basis the evidence, the post-merger evidence, that HDFC Bank has a more muscular deposit generation engine than many other private sector banks. That I think becomes the key differentiator. If they can keep that more muscular deposit generation business, that will allow them to then grow their loan book. Given their asset quality is already superior, I think over the next couple of years, once again, that aura of superiority should return, and the valuation multiple ultimately is nothing but the market's perception of the gulf between a said bank and the rest of the market. In a economic recovery of 21, 22, 23, 24, everybody was doing well, and hence that aura disappeared. And I've lost count of how many people told me, "Farak kya hai SBI or HDFC Bank mein?" Let's see what the next 2 years show us about that, on that point of view, or farak kya hai SBI or HDFC Bank mein.
Okay, so current multiples you think have can see an upside from a valuation perspective.
So simpler way to if you want to do the multiples wala piece, I think forward PE will be at 15, right? Forward PE at 15. That the 20-year low I think was around 12, right? And if I put my hand up, we did increase our position size when it was at 12 times forward PE. At 15, it's still well below. It's way below its long-term averages. And what is the steady state valuation multiple of a bank like HDFC Bank? That depends on can they grow their deposits and loans, therefore, at mid-teens. If they can grow deposits and loans at mid-teens with some treasury income, fee income, NIM improvement, that should allow them to get to 17-18% earnings growth. The market would be happily willing to play a much higher multiple for a bank growing earnings at 17-18% in what looks like a
and you think that is possible? Isn't the current environment or the context of competition make it a little...
In fact, I would say the current environment is better because as liquidity is getting tighter, as banks are finding it harder to get liquidity, and as NBFCs are finding raising money, raising commercial paper in the money market is getting more expensive, that allows HDFC Bank to stand tall. So this is exactly, I think, where the challenge was 3 years ago. 3 years ago, everybody could grow at 15 to 20%, and the point of view was, why pay extra for HDFC? As growth becomes scarce in our country, both earnings growth generally, but more specifically deposit growth becomes scarce, if Shashi Jagdishan and team can deliver mid-teens deposit growth, then I think we'll see a re-rating here.
Okay. And why go digit? Because right now I'm also looking at, of course, it's your play. But the entire insurance industry has got sort of, most of those stocks have, shed more than 30-40%. I mean, even over a 5-year period, you would see probably they're just 10% thereabouts higher than, 5 years back. Because of the flow of news, I guess. HDFC Life, I think, went up 10% after the result, and Prudential went down 10% the day of the result. So there is such stark contrast. Do you see any value emerging in the traditional insurance plays, or you would focus only on the reinsurance bit?
Yeah, I think you make a good point about how volatile the life insurers have been on results. I think generally you're seeing that across the market, right? And that's a sign of a very jittery market, right? When large companies, right? And this was true even in the IT stocks. I was seeing IT stocks may mild surprise positive and goes up 10%, mild negative surprise goes down. That's a sign of a jittery market. That's also a sign of a market where liquidity is diminishing, right? And therefore, I think that whoever is watching, I think that's a sign to you, to all of us, to be careful, because I think we're in a very tricky market in an economic downturn. But on the specifics of why go digit, life insurance is something we've avoided, right? We used to have HDFC Life, and then when we saw the whole complication around the government's view on 5 lakh ke upar ticket size ka kya karenge, and the more work we did, the more data we saw, the more we realized that tax benefits seem to be a big part of the life insurance play, and that made no sense to us. We are buying life insurance for life insurance, not for playing the stock market or for tax benefits. We exited life insurance, and I'm circumspect about life insurance for a whole bunch of reasons, which we can discuss some other time. The reason on general insurance we feel optimistic is, much like in banking, the PSU general insurers are seeding ground, right? And many aspects of general insurance are still underpenetrated. So for example, whilst motor third party is mandatory, motor own damage actually has very low penetration. Motor own damage still has plenty of room to run. Similarly, medical cover, mediclaim cover, right? That's for obvious reasons, given that the government is not building that many more hospitals. Every company, every person now wants either corporate cover or they're buying cover themselves. That has room to run. In an environment where I think discretionary spending in India will tighten. I think discretionary spending is tightening, will tighten further. I think spending on insurance will be one of the few items in our country where spends will go up as households realize that in an increasingly free market economy, you need to look after yourself. There is no andata, there is no sarkar looking after you. So in that regard, I think there's a structural growth story here. Amongst the private sector insurers, ICICI Lombard is our bigger investments. It's been a long-standing Marcellus investment. They've done well for us. We invested in Go Digit because it's a newer insurer, more tech savvy, and it's only recently become profitable. I think the firm is 5-6 years old. Last year was the first year of profitability. And when I was much younger and had far more hair on my head, I was a general insurance analyst in the London market. And one of the things I learned very early on is, when an insurer goes from losses to break even and it has good underwriting skills, it has plenty of reserve releases. You tend to over reserve when you're a young insurer because you want to be conservative. Then as you turn profitable and as your data firms up that I've done good underwriting, you release those reserves. So my reading is, over the next couple of years, I think Go Digit will produce more reserves. If you want to sort of delve deeper into it, the Prem Vatsa and Fairfax team were also the people who were associated with ICICI Lombard. They did a wonderful job there. And by all accounts, it's been a happy partnership between Kamesh Goel's team and Prem Vatsa's Fairfax team, and we're hoping that will continue and we can enrich ourselves on the back of that.
Okay, fair enough. I'm tempted to ask you more about life insurance, but some other time, like you said. Okay. Second idea is export-centric plays.
Yeah, so there's two drivers here, right? The obvious driver is the Indian currency is coming off, and therefore, if you translate dollar earnings back to rupees, you get a little bit of a fillip. That's a simpler driver. I think the bigger driver, and this is very evident in the export data, the American economy seems to have a full head of steam, right? And we're seeing all sorts of exports from India into America pick up steam. On an incremental basis, even China seems to have turned the corner, right? So overall, our manufactured exports, IT services exports seem to be on the mend, and this is not company specific. This is a broader economy piece that we are seeing in the data. Effectively, post-COVID, we had a slump in our exports, and we seem to be coming out of that and normalizing our export story. So given that American economy is buying more Indian stuff, if Trump makes America great again and puts tariffs and American manufacturing takes off another notch, I think we stand to benefit. So again, on exports, the plain vanilla play would be IT services, right? Typically, IT services goes through two years of fallow spending and then 3-4 years of punchy spending, and much of your share price recoveries tend to be front loaded. I think we've begun that cycle. Our vanilla play on this is HCL Tech. This is a large cap play. It's in our consistent compounders portfolio. We also have, by the way, a separate part of Marcellus. We built a separate team to invest specifically into America, primarily America, to a lesser extent Canada and Europe, focusing on American manufacturing and American technology. Right, that's a separate play. We felt 2.5 years ago that our Indian clients need to diversify into high technology companies, manufacturing companies in the Western world, and that's a separate part of Marcellus. It's called the Global Compounders Portfolio. But our more esoteric, more niche play on exports is a company called Clean Science. Right. So they are leaders. They are historically leaders in chemicals which go into the FMCG industry in the Western world, things like guaiacol, anisole, right? But where they've been very innovative, very clever is identifying high-end chemicals. So there's something called hindered amine light stabilizers. These things go into the paint that goes into your car, for example, right? These are high-end chemicals. India has historically never made these, right? HALS, hindered amine light stabilizers, HALS is a $1 billion global market. Clean Science has become the first Indian company to make this at commercial scale. That business is going well. So this is a specialty chemical company. In the post-COVID pomp, operating margins were 45% plus. I think operating margins in the normal world will stabilize around the 35% mark. Over the next 2-3 years, the capex that's been underway, I think if that capex bears fruit over the next 2-3 years, they should be able to generate around 500-600 crores of cash flow every year. And on that basis, a company, $2 billion, not even that actually, little below $2 billion market cap company generating best part of $100 million of annual free cash flow, plenty of room to run, deep skills in specialized chemistry, I think is a very exciting prospect. This company has been created over the last 20 years. Very little primary capital has gone into it, right? So it's one of the great stories of Indian entrepreneurialism, how creative chemists in our country are able to build highly profitable ventures. Right. Yeah, and all of these, I stress, are part of our portfolios, and therefore I have a vested interest. I'm invested through our portfolios, and so are my parents. Fair
enough. See, one of the concerns right now in the market, Saurabh, is that a lot of mid caps have run up very sharply, and in the last few months, obviously, there have a lot of pockets of stocks have corrected very sharply, 30-40%, because the earnings growth in the medium term has slowed down, and valuations were obviously very steep. How do you evaluate Clean Science valuation with regard to how things will pan out over the next 1-2 years?
Yeah, so on that, I think Clean Science over the last 3 years, the stock has halved. Right, the stock has halved, and because the bulk of the earnings come from export markets, and as we were discussing during COVID, the global giants stocked up. They had excess inventory. They loaded up on excess inventory out of sheer fear. And then through 22-23, even the early months of 24, they ran down their inventory.
Right.
I think looking at the export data across a range of companies, a range of sectors, Mahalakshmi, I think that inventory correction cycle in the Western world seems to have run its course, right? And as I'm saying, the last 6 months of export data across a range of Indian manufacturing, specialty chemical companies has been very encouraging, right? And it's year upon year growth, quarter upon quarter growth. We've also seen almost a full year of non-stop growth in our exports, right? Now, this is without a major China plus one fillip.
Right.
If Trump does I think he'd said at some stage some 70% tariffs. For some reason he didn't repeat it in his inauguration speech. I was kind of hoping there'll be some mention. He didn't. He'd mentioned 70% tariffs on China during his election campaign. Well, even if he does a far lower number, I think the China plus one plays, and clean science would be one such play, would benefit. We also have Divi's lab in our portfolio, which would benefit on that. So without China plus one, India's exports in the chemical sector, specialty chemical sector, manufacturing sector are recovering nicely. If China plus one plays out, then I think there's plenty of room to run here.
I'm asking only because I don't know the math, but I'm just seeing that it's now 60 times trailing earnings, and many of the times the problem, we've also had this conversation earlier, is that many of these businesses are good, like you say, they are a unique company with a very unique business, etc. But it's all priced in.
I agree with you. So in clean sciences case, because the end markets are scattered, there isn't that much brokerage coverage of it. Basis whatever we see, both our projections of around 20-25% earnings growth and what we see from the few brokers who cover it, you're paying around 45 times forward for it, right? If you want to put it in terms of multiples, at its peak you were paying closer to 60-70 times forward for it. As I said, the stock has halved over the last 3 years. If you have a business which can grow cash flows at 20-25%, operating margins are 35%, return on capital is 30-40%, I think richer valuations can be sustained. But ultimately, as you've said a few times in this conversation, growth is what matters.
Right.
If growth recovers, the multiples will sustain, indeed improve, whether it's HDFC Bank or tiny clean science. But if growth doesn't recover or goes backwards, then we'll have a further correction in many of our portfolio companies.
Right. Fair enough. Third idea.
Yeah, the third theme, I think this is a harder theme, right? Because as we have seen in the Maharashtra elections, now in the Delhi elections, in the Karnataka elections, that which doesn't matter which political party, the recipe for success in Indian politics is to give money to those earning less than 5 lakhs a year. So basically 80% of India, 85% of India earns less than 5 lakhs a year. That's where the vote banks are. People who earn above 5 lakhs, there's only 40 million people in India. 40 million people in India earn over 5 lakhs and India has 640 million voters. So you can understand, right? Those people earning above 5 lakhs are electorally not particularly important, right? Now, if all political parties understand this arithmetic, it, I think, to my mind, is a no-brainer that in future, between now and not just the next general elections, but well past that, there will be a culture in Indian politics of doing targeted benefits for the poor, right? And we are already seeing that in the last 3 assembly elections. I think this will become a theme in Indian politics. So the question is, we as investors, how can we make money from the largesse of Indian politicians vis-a-vis their critical vote bank, which is those earning less than 5 lakhs, right? So it's not just, when we say rural India, a lot of people have this vision of farmers and, kheti and all that. I think I prefer to call it non-urban India, right? So non-urban India is a theme which is actually holding up. So last couple of months, we've been spending a lot of time in non-urban India, and it's actually a far more vibrant demand ecosystem than, say, the nicer malls in Bombay, Delhi, Bangalore, right? So how can one invest? Our straightforward play when we first started understanding the theme was Escorts Kubota. It's the leader in tractors is M&M, but Kubota is the world leader, and Kubota owns, I think, 54% of Escorts now. Our reckoning is with Kubota's light tractors coming into the Escorts lineup. Escorts' tractors were heavier tractors. The combination of Escorts, Kubota's tractor lineups looks pretty pretty compelling. Kubota's also said, Escorts Kubota said they'll bring in a NBFC, which will kick into life, I think, in the next few months. Then comes Japanese Kaizen, which hopefully will give us a margin uplift. And then the hardest part. Our work suggests that the quality of dealers that M&M has is far superior to what Escorts Kubota has. And if the Japanese can put their muscle behind improving dealer quality, I think this company will end up gaining share. At the moment, it's not gaining share. As yet, post the Escorts Kubota deal, we haven't seen market share gains. I don't think the stock market is yet particularly enthused about market share gains. But I think it's doable. The quality of the product is there. The NBFC is around the corner. Tractor demand itself is pretty buoyant. As you might have heard from other people, there's nobody in rural India wants to do any manual work anymore. Right? You could argue we don't want to do manual work. Why should they want to do manual work in rural India? Therefore, everybody wants a tractor in rural India. There's funding available from the banking system. The political class also wants to fund this. If Escorts Kubota can grab, say, 15% of this big tractor pie, I think we can make a lot of money here. So this is our sort of plain vanilla idea. And then as we kept traveling around the interiors of the country over the last year, we were looking for a company which could give us multiple legs of this, right? So pesticides, herbicides, dairy, agri-commodities. And Godrej Agrovet was the company we invested in roughly a year ago. So it's run up since then, but even now I think there's value there. We're still holding on to much of our Godrej Agrovet. Its main businesses are, as we were discussing, pesticides, herbicides, where they've been licensed some particularly potent Japanese chemicals, which are doing really well. The hit product is called Gracia. And then their oil palm business, where with a little bit of help from the government, they help farmers grow oil palm, and then whilst India imports 90% of its oil palm, much of what is grown in India comes from Godrej Agrovet. Our country would love to reduce its import bill, and therefore the upside prospects for Godrej Agrovet, if they can scale the oil palm business, if they can get more farmers to grow oil palm, the upside prospects are very high here. The capital employed is actually very little, because the Godrej is basically giving the farmer the seeds. Right. The farmer is growing the oil palm on his farm, and then all that Godrej has to do is guarantee an offtake to the farmer at a price linked to the global price for palm oil. Right. And they're therefore buying an agri-commodity from the farmer at close to the global price, and then you're processing it and selling it to the hotels, restaurants, FMCG, and so on and so forth. So the ROCEs are particularly compelling. So if the dairy business, the oil palm business, the pesticides, fungicides, herbicides business, if that continues to flourish, I think this becomes a multifaceted play on the revival of rural India. I mean, many of your viewers will be very young. They probably won't remember that 2011, 12, 13, for those of us who've been in the market for a while, there was a big rural play back then, and then it died away. And I think it seems that we are at the cusp of a revival in, let's call it non-urban, I think non-urban play.
Right. So with respect to Godrej Agrovet, I remember seeing this stock, and when you bought it also, and I wondered, this is not a company which has very high return ratios. Last 2-3 years, it's also not shown very remarkable growth. So in terms of numbers, do you see those things getting bridged over the next 2-3 years?
Yeah, it's very interesting. So when we bought it, right, the reason we bought it was, we said, it was very interesting. We said this company is a leader in several areas. So for example, in oil palms, it is the leader. It's by some distance the leader in India, right? It's got the most amount of area under cultivation, the offtake from the farmers, so on and so forth. And the oil palm piece is actually a high ROC. I think the ROCs are 50-60%, because there's very little capital employed. You're simply buying the crop from the farmer at the global price, and there are 3 plants where they crush it and literally squeeze the oil out and sell it, right? So this was a firm with basically 4 different lines of business. They also have an animal feed business, right? Which is animal feed for cattle, for fish, and for poultry, right? And in several of the businesses, they actually had leadership in the niche. And yet, as you said, when we bought it around 4 years into its post-IPO existence. Revenue CAGR over the preceding 4 years had been 11-12% Mahalakshmi, but EPS CAGR was 1%.
Right.
So it was a reasonably simple discussion for us with the folks running the show, saying, you guys are running, at that time was market cap was around 7,500 crores, that you're running a colossal business with pockets of excellence, high cash generation in those pockets, and yet in the totality of it all, your earnings growth has been 0, or 1%, even though revenue growth has been pretty decent, right? And effectively what we were getting at is the scope for margin improvement. What we have seen is that the margin improvement has started coming through. Now, how much of that is because, as you might have read, right, I think in July, August, the Godrej family did a big sort of reshuffling and reorg, right? My layperson's take on the reorg was, post the reorg, I think we'll see much sharper focus from the promoter family on this business, because it has many promising bits to it. It has some parts which are market leaders with good ROCE, and other parts which could do with efficiency improvements. Now it's incumbent on them. They own 75% of it. We own percent of it. It's incumbent on the promoter family to drive through the margin improvements, the efficiency improvements, and turn the leadership in market to a high ROCE for shareholders like us. Because as you're rightly saying, even though there are several bits of the business which have high ROCE, in the totality, the blended ROCE is just above cost of capital, right? And therefore, our read was there's room to run. And then linking back to macro, I felt that the political class that runs our country would want to help that oil palm farmer, right? They'd want to get pesticides, fungicides, the dairy sector, the animal feed sector, crops, so cattle and poultry particularly, but increasingly fish cultivation in northern India, right? So we put the dots, we joined the dots and said effectively we were a firm with, say, the same number of employees as, say, a much larger market cap business such as SRF. Right, this firm has roughly the same employees as an SRF, but the market cap is 1/5, 1/7 of an SRF, right? And SRF is also, remember, a quasi-commodity business. So it's not as if I'm comparing apples with oranges. So our reading is there's scope for improvement.
So you do think that the management is open to the idea of, shelving some of the low ROC businesses, focus on some businesses which are excellent, and therefore over the next 3 years or so, the complexion of the company might change. Is that your bet? So exactly what they'll do, you'll have to ask them. But my hope is they do that, because as you're alluding to, in each part of Godrej Agrovet's empire, there are natural comparables in the market. So pesticides, herbicides, say Dhanuka would be a credible comparator. In dairy, and Hatsun would be or a Dodla would be a credible comparator. Similarly, in oil palm, there are other agro-commodity businesses in India who are relevant comparators. So it shouldn't be a particularly challenging exercise to say this becomes a holding company, Godrej Agrovet becomes a holding company, and then you create standalone businesses which get listed on their own. And if you do that, you're also able to give incentives to employees at the divisional level, and that could potentially drive the margin improvements required to bridge the gap between good top line growth and more modest bottom line growth. Right. All right. Since you have given us only 3 ideas, I'd want you to give us something more. So 3 themes, 3 themes, but we need 5. So let me ask you a couple of questions. One is, how do you see this earnings story play out? Because people are saying, usually, till about last quarter, people were still predicting 5% for this year, 12% to 15% for next year. Do you see 12 to 15% happening in FY26? Yeah, look, a lot these earnings estimates come from brokerages, right? And you have been on that side. I've been a broker. So tell us. Look, in an economic downturn, albeit a cyclical economic downturn, looking at brokerage estimates and trying to figure out how the future will pan out, it's broadly in line with going to a barber and asking for a haircut, right? And as you won't be surprised that even when I go to the barber and he happily gives me a haircut and charges me full whack, although I notice he gets the job done in 2 minutes. My 17-year-old son, it takes half an hour to cut his hair and it costs the same amount, right? And I find it very unfair. Anyway, coming back to brokerages, now I think that those mid-teens earnings numbers are
I think, from the realms of fantasy. We went through the same process this year again. This year when we entered, it was reasonably clear we were going to get an economic slowdown, and yet the brokerages entered F25 with 15-16%. I think it's now more like 6-7, if that. My reading is, I think 26 will be a similar story. They'll keep the numbers jazzed up so that the forward Ps look low, and as we go further through the year, they will pull the earnings back. Now, leaving aside whatever they do, that's their business. What we are doing at Marcellus is, I'm being very cynical about our own growth estimates for F26, right? We are all human beings, and like anybody else, our analysts, our fund managers also like to take last 2-3 years and drag it forward, expecting that the economic bounce of the last 3 years will sustain. I think the odds are it won't. And therefore, my suggestion to my colleagues is take a haircut, assume far lower earnings growth in 24 than in far lower in 26 than in 25, right? If you can show me a theme such as exports where there's drivers which are kicking in anew, I'm happy to buy into higher earnings growth next year. But barring new themes which will drive earnings growth, I think we'll see more moderated earnings growth going forward, which in turn translates into a greater degree of caution than we have historically demonstrated on valuations, right? Because through the 21, 22, 23, 24 upturn, perhaps our mistake in that upturn was not being as cognizant of valuations as we should have been, and especially in calendar year 22 and the early part of 23, we paid the price for that. Since then, we become more circumspect, but perhaps the degree of circumspection in valuations needs to go up another notch as we enter an economic slowdown.
Fair enough. One last question on, in this environment of earnings deceleration, what do you think are the pockets that should be avoided, which are more vulnerable to earnings downgrade than others?
I think the biggest pocket, if you ask me, is this whole government capex wala ecosystem, right? If you look at this year's tax collections, year to March 25, direct and indirect tax collections are running at 8%, right? The budgeted growth was double digits, right? So already very early in the downturn, tax collections are going to fall short of estimates, right? Secondly, as we were discussing, post the 2024 general election, the subsequent assembly elections have shown that giving poor people more money results in big electoral dividends, right? So joining these two dots, that tax collections are going to become tax collection growth will become more moderated as we get into a downturn, and those earning below 5 lakhs, which is 80%, 90% of the voting crowd, needs more money. I think it'll be astonishing if government capex doesn't moderate in F26, right? Whatever the government might say, I mean, if I was them, I would say I'll keep government capex strong, but in reality, given the realpolitik, I would curtail it to balance my books. Remember, all credit to the dispensation really, they've been fiscally very conservative. Other than the stimulus during COVID, they've been fiscally conservative. So let's do the math. If we are at 4.9 and they want to go to say 4.4 for F26, that means your government spending will grow significantly lower than nominal GDP growth. Nominal GDP growth itself hitting double digits, I think, will be an ask, and therefore government spending will have to grow at single digits. Now, on that single digits, do you really want to mess around with your vote banks, or would you rather throttle off on capex? I think the answer there is reasonably easy for me. So that entire ecosystem, I think, is overdue a pullback, right? Contractors into the roads ecosystem, the defense ecosystem, the railways wala ecosystem.
I think all those counters have already seen quite a bit of correction.
Yeah, but I've seen many of those companies used to have a PAT of 5-10 crore. They went to 100-150 crore ka PAT. I think that PAT going back to 5-10 crore. Right? So just think of it like that, right? If you,
so you're saying not only a valuation pullback, but also a earnings driven pullback.
Your earnings is entirely government spending, right? You basically one customer in, you could say ye PSU hai, wo PSU hai, ye state government hai, wo central government hai, but effectively you've got one large customer, which is the government in its different avatars. And as that government gets centrally constrained, because remember, the central government is fiscally constrained, the state governments will also get fiscally constrained, and if the government is constrained, they will suck out from PSUs cash through dividends and so on, right? So wo wala story I think is the most vulnerable here. The second area where I worry about, and we've also worried about it even in our context, is I think the middle class consumption piece is looking seriously challenged, right? It's not just, it's also not just me. Bhargava Saab at Maruti has said the same thing, that below 10 lakhs car sales have dwindled. I think the Nestle chairman said something similar. We saw Unilever's results yesterday, right? I think flat volume growth, right?
Yes.
So the middle class consumption piece looks challenged. Again, going back to, if you look at India's income tax data for the year gone by, there's roughly 40 million Indians between 5 lakh per annum income to 1 crore. And those 40 million Indians are paying 70% of India's income taxes, right? And in that ecosystem, AI, the transition to AI, the transition to automation in factories is having an impact. I think middle class consumption plays are something we need to be, all of us, and including I'm talking to myself as much here as to the audience, we need to be very circumspect of, because I think we are going to see a very tough couple of years for middle class India from a income growth perspective, and I think there's a lot of debt as well. There's a lot of credit card debt, auto loans, home loans, student loans in middle class India.
That's all on the show today. I hope you enjoyed watching the 3 ideas that Saurabh had to offer. Best of luck for 2025. Thank you so much.